Hello, everyone. Adam DeMarco here. Don't adjust your TV set or screen monitor. Anthony Mento not with us today, but I'm his partner and jumping on. I got some guests from North American and New York Life joining us. We're going to give everybody a moment here. So we're getting started here to jump on. See our participants are joining. If anybody has any questions, leave them in the chat. We'll take care of those towards the end. And excited to talk to you guys today about what we put together. Again, thanks to our friends at both New York Life and North American who are gonna represent two sides of the coin in the permanent life insurance discussion. So a lot of what we're talking about today is reasons for planning, types of planning, solutions to different climates and different things that are going on. North American happens to have a really robust universal life offering, whether it's for protection purposes or accumulation purposes. And they are relevant in the accumulation space, but they're about to become a lot more relevant because they have a new product coming out next month that we're excited about. So we wanted Steve to join us. And then Rick Blaser represents New York Life, which is among, if not one of the best whole life contracts out there, certainly the best financial rated company in the country. So we're excited to have both of them there. And we'll get started here. So I'm gonna share the screen here, and we'll jump in. So the title today is Generational Wealth Planning with Life Insurance, and what we want to talk about today is what we're doing now in the face of some of the changes that might occur. We don't know what's going to occur from an estate planning standpoint. There's all kinds of different proposals, and there's different things that are going on in the economy, in the government. So what we don't want to do is speculate. We don't want to talk about what might happen or start to read the tea leaves to figure out what we're going to do. What we're going to talk about today is that regardless of it, there's a whole other world of planning that I wouldn't say people are foregoing, but they're also just, maybe we need to dust it off and think about reasons to do estate planning that aren't just estate tax driven. So, I want to kind of start with where we're not, and we'll talk about that in a second. And then I also want to talk about, this balanced approach to life insurance, which is something that Steve's excited to talk about in the way that the flexibility of a universal life contract can build in multiple outcomes in the future, not just, for one geared to one type of design. And then we're going to talk about the Secure Act and some of the changes that happened during that and the life insurance opportunities that created. And then lastly, we're going to talk about building a whole life contract to structure for generational planning for people that have already done their estate planning and are starting to go down to generation 2 and generation 3. So I'm gonna jump on here with where we're not, which is we're not in any of these years. We're not in the year 2000. We're not in the year 2011. We're not in the year 2020, and we're not in 2026 yet. And I'll talk about why that's important in a second. So in 2000, the exemption was a lot lower. So the exemption for federal estate tax was, call it just about $700,000. If you're a married couple, $1.4 million. There were over 50,000 Americans that paid an estate tax in 2000, just in the year 2000. And stretch IRAs were obviously available because they hadn't gone away till a couple of years ago. So if you had an estate that was worth $10 million and you were married, you could be subject to, upwards of $5 million in taxes on a $20 million estate, $10 million in taxes. So the traditional life insurance planning that we did in trust was designed around, taking care of the state tax liability. And I think that was good work that we did. And we're continuing to do that work. But as you'll see, even in 2011, which there were some big exemption changes. So the exemption went up a lot, right? When we had these exemptions then, a $10 million estate for a married couple was no longer taxable. For $20 million estate, yes, it was taxable. And certainly for a single life, if you had $10 million estate and you were single and not married, then you were subject to taxes. But when you look at it, only 2,500 people paid estate tax in 2011. So compared to 50,000 10 years prior. So again, the planning that we've done when we talk about what happens if estate tax changes, if it gets repealed, that's something that obviously we have to deal with, but in reality, we've been dealing with it for a long time already. 2020 was kind of an odd year, actually. There was a lot of filed returns, but not that many people actually paid because even a $10 million estate wasn't taxable anymore for a single life. And there's just not that many of these people out there. I mean, there's some, but the ones that exist, they didn't pass away. So there wasn't a lot of people that actually paid estate taxes that year, for as much as we talk about it and worry about it. And then where we're not in 2026, we don't know what that's going to look like. So there's proposals that the exemption can stay at where the Tax Cuts and Jobs Act is, and it's just going to be extended, right? That's going to look like 14 to 28 million, depending on single or joint life. It's, if nothing changes, if there's no agreements and no new legislation and no extension, it's going to revert back to what it was, paced for inflation. So it's going to be between $7 and $14 million. So if you have an estate that's worth $10 million and you're married, you're likely probably not going to pay state taxes, although they might change it. But if you are single or you have an estate that's $20 million, it could be upwards of $5 million of estate taxes or none. And when you look at the projections, at least for how many people would be affected, if there's a reversion, there's probably going to be about 9,000 people in our country that probably would be subject to estate taxes that would pass away in 2026. That's based off actuarial statistics and what the tax code would be. If there's an extension with the exemption, it would be about 4,000 is the projection that I've seen. And obviously, if they get rid of it, then nobody's paying estate taxes, and we have a whole other situation to deal with. So what we're going to talk about today is absent of estate taxes. It's generational planning. And what we want to talk about is, what is generational wealth? You know, is it $5 million? Is it $10 million? Is it $20 million? Is it a house? Is it $100,000? Different people for different estates will have completely different definitions of what this is. And I think it's best if we don't impose our definitions as being, you know, people that are in maybe the high net worth planning environment. You know, it could make a world of a difference. You know, if someone were to be able to pass along significantly less than that, that could be considered generational wealth for different people. And I you know, the variation, I think the definition doesn't really exist. I think it's different for everyone. So I think the better question is, you know, how much money do you not need that you want to leave to the next generation? And is there a way to leverage that and leave more? Whether it's life insurance, which is obviously, we're life brokerage, so obviously we're going to talk about that today. But, you know, income planning with annuities, can we get you more of your money guaranteed and then use the life insurance as a leverage to leave this generational wealth to your family? Can we get you long-term care coverage or chronic illness coverage that's going to protect the estate in different ways? And then can we start to, if all the planning is done for yourself, for your income planning, if you're the retiree, right? And all your planning is even done for generation 2, because you've done all this great estate planning. Is there educational for planning that we could do for grandchildren, or generation 3 type planning? That's generational wealth in my definition, is to be able to take what you don't need and you will never use and start to turn it into things that are going to be for your kids and your kids and even really beyond, to create this legacy. And I don't think we could define that by the standards of just what the IRS and the government says, where you have to pay a tax on it. I think that that's where we've kind of, our mindset has been. And, you know, the discussion today is to, you know, come off of that a little bit. So, you know, some speaking points for, you know, we're advisors. So, you know, I like a lot of these things that I hear people say. You know, I hear them say it in different calls or in meetings. You know, just because the state tax doesn't exist doesn't mean you don't want to pass wealth down. You know, and I think life insurance is among the best wealth transfer tools available. It's money exactly when you need it for what you need it for, right? And we're going to talk about some instances where it's still completely relevant, and even some taxes that exist that exist at death outside of the estate tax. And then, you know, I think in some ways, you know, ideally, you know, but no opinions as to what people would want, you know, from a moral standpoint, as if estate tax is good or bad for, you know, the country, or I'm not getting into any of those conversations. But really, estate planning is more simplified now, because if there's less people paying taxes and less complications, we could just get into more direct conversations about what people actually want to do, without this whole other thing of how we're going to do it and have to do trust planning and gifting and all these ways that we have to do it to be able to take care of a tax. If that's not there, or it's simplified, or there's less people subject to it, we could get into the real things that really matter to people, which is, how much is going to go to my kids, and do they not have to sell off the business or the family farm or the shore house or stuff to take care of things, and how do I do that? And that might actually be easier now. So I think with a lot of the uncertainty, I also think it's, there's also, pluses and minuses with everything. So, get into what it is that we're doing and how we're structuring things. So, what I wanted to talk about with this balance approach, and Steve's gonna jump in a moment to talk about why that's relevant for North American and what they have to offer with that. But we, just quick reminder of kind of why people are buying life insurance, permanent life insurance for estate planning purposes or for other purposes in retirement. So kind of get into a couple of conversations here. First being just a reminder, we like to put this in a lot of our presentations. Just life insurance has special provisions inside the tax code. It's unique in a lot of ways, and these are the sections of it that you can refer to if clients are just good for you to get a refresher. So essentially, life insurance is for mostly for widows and orphans, right? It's not supposed to be taxed. And it can't be taxed because it's being used to sustain our economy. I mean, our life insurance companies, in combination with annuity contracts, pay out about a third to 40% of what Social Security and Medicaid and other entitlement programs pay out. So sitting behind the governmental programs is this whole industry that we represent that puts a lot of money in the economy for people, for seniors, for families, and it is it's created in the private sector, but it's something that exists it's sustaining our economy and keeping a good floor on where people are at. So I like to always, put this up here, and we'll share these slides with you so you have them, but it's important to know the gist of it, nothing that none of you don't already know, but life insurance, death benefits are tax-free, tax accumulations tax-free. And also, if you access the money properly, you may not have to pay taxes on gains, right? We all know that. These are the reasons why that exists, right? So what we also like to talk about in the context of a permanent life insurance conversation is asset location. And there's a lot of good material out there with different carriers, and there's a lot of conversations around this. I happen to like this piece that we talk about, and it talks about asset allocation, which is something that I would think most clients and certainly all advisors would be very familiar with, and that there's a power to diversifying your money in different investments, right? That's not the conversation we're having. We're actually having a conversation about asset location. So not what you're invested in, but where it's actually at. Is it qualified money? Is it non-qualified money? Is it Roth IRA money? And how is that going to work? Because if you can find a proper mix, you can start to dial down your actual tax bracket. Because if you have a lot of qualified assets in retirement and you distribute them down, you have no choice but to pay these high incremental tax rates. But if you have a mix of different locations, all else being equal, you can choose when and how to take them. And if you don't take from the qualified assets or ordinary income assets in retirement, when you're at the higher tax brackets, you can effectively lower your tax bracket and choose when you want to spend what money. And you could actually have more money to spend if you do that. And that's where life insurance comes in, among other things, but life insurance primarily because it's tax-free in its nature for distribution planning. So, and to illustrate this, people, this is another slide we like to talk about. And it's just people say, I'm getting killed in taxes. Somebody's making $731,000 a year. Yeah, I'm paying 37%. Well, you kind of are, but you're kind of not, because everybody's paying 12% for the first 23,000. So yes, you make $731,000 a year and you pay 37% tax. That's true, but you didn't pay it on you didn't pay it along the way. It's incremental, right? So the first 23,000, myself, a billionaire, somebody making 23,000 a year, they're paying 12% on a married filing jointly. And then as you go up the ladder, the big jump is from 201 to 383, right? And that's an 8% jump. So if we have people that have a mix of asset location and they have money and assets that they can take that don't bump that up in retirement, that can be really meaningful. It's a lot more meaningful when you talk about if someone is only single, if they pass away or they're divorced and they're finally single, it's a big difference there. So that's what we want to try to manage. And if we can get ahead of that, not wait till you're 70 and start to reallocate or convert to Roth IRAs. It's more about if you are 45 or 50, if we could start to diversify your asset location, you're going to have all these different opportunities in retirement to avoid some of these situations and this higher part of the bracket. There's also Medicare surcharges that could be pretty substantial. That could be $10,000 a year that you might be able to bypass if you properly plan ahead and do that. And the reason why we do that, and one of the things that I talk about is there's basically you're going to pay your taxes. So this isn't about a tax dodge or anything. You either pay your taxes now, you pay your taxes during the process of retirement, of accumulating for retirement, or you pay your taxes at retirement. So if you pay your taxes now, that's the life insurance conversation, the Roth IRA, right? You don't take a deduction now and use after-tax money and that leverage of the efficiencies of how those locations work, right? You can pay your taxes along the way if you're in a non-qualified account and you're doing investments, right? You could just pay them as, capital gains or pay them along the way, or you could pay them in retirement. So the bad news is you can't get around taxes. The good news is you can choose when and how you pay them. And when you choose to change change the structure of it or have multiple ways to do it, you actually are reducing your risk in some ways because we don't know what taxation is going to be in the future. So if you have multiple types of location of assets, it's at least reducing the risk of the portfolio that you have in retirement for that. And that's where we, talk about this again, tax now, tax later, tax never, right? But really the tax never is you didn't get the deduction up front, so you're kind of paying the tax now. But in that instance, if we could fill up these different buckets with money, it can create some possibilities, again, to manage your tax bracket or for just, a more sustainable retirement. By the way, by doing it, which Steve's going to talk about, and with life insurance, you're also creating that legacy piece to it as well. Another good chart that we'll put in with the collaterals that we send out, but, it just talks about the differences of all kinds of different plans, including tax value life insurance, tax cash value life insurance. So, we'll send this out to you. And, before Steve jumps in, I just wanted to remind everybody about a piece that came out last year with Ernst & Young. We like third-party stuff here. So there is great collateral pieces from all of our carriers that, we suggest that you get familiar with and clients might want to read. But when you can send something out from a company that doesn't sell life insurance, it's not an insurance company, they're not an insurance agency, and they talk about how they did an analysis and figured out that weaving in life insurance contracts and annuity contracts is more powerful and makes investments more powerful than investments themselves. It's a really great article, and I would suggest every financial professional on this call reads it. We could send it out. And it is designed for, essentially for public consumption. It's created by Ernst & Young. So if you have that, I would suggest for your clients that you think would want to read it, it would be interesting for them. And it at least gives them a third-party introduction to some of the stuff that we sell, so they're familiar with it, and they might want to ask more questions and get more familiar with it. So I'll turn this over to you, Steve. What is the difference that we see about structuring a policy, particularly a universal life, at the maximum cash value, how we've already done it, and what is it that you're suggesting? Because I will say that we've seen situations where clients can mech a policy. We had a client that had to get a refund check for 17 cents to reverse out a mech because we designed this thing so razor thin. So I wanted to talk to you about what you're seeing in reality with the policies that are coming through your office, and also, what you wanted to talk about today as an alternative design to this traditional approach.
Hey, Adam, thank you. And good morning, everybody. It is excellent to be here. Life Brokerage is one of my favorite operations or my favorite agencies we work with. It's really an honor to be here. I know I can speak for Rick as well. We're really happy to be here with you guys. So let me just make a couple of quick comments. Using life insurance as that multi-purpose tool for tax benefits and other things really has become increasingly popular. What we wanted to do for the next couple of minutes here with my part is to share a creative way of thinking to take your client value to the next level. So in terms of the traditional approach, what we've always done is we've looked at a minimum death benefit, maximum premium, maximum illustrated rate. Like here, why have we done this? We've always done that, because that's what we've always done. It's It has a benefit, it has a negative. So what I would suggest here is the benefit of when you're doing the traditional approach, minimum death benefit, maximum funding, you get a compelling illustration. You win the illustration game. At the same time, you've got some drawbacks. It may not materialize the way you're showing it to the client in the illustration. Also, when you're showing a minimum death benefit, you also you probably don't have enough death benefit for the client. So what I wanted to suggest is, if you think about innovation, we saw a couple slides ago, some images there. Think about other things. Think about, I've got 2 iPhones on my desk. I've got a number 8 and I've got a 13. Why do things get better? They do more, they cost less. Life insurance has done the same thing. Think about how you apply these principles for your client value. So the balanced approach, what I would suggest here is take a look at a little bit more death benefit. What's that going to do for you? I mean, aren't we here for income and accumulation for our clients? But if we take the balanced approach basically says a little bit more death benefit for our client. We're going to have more protection while the client's alive. What if something happened to them? We're going to have a bigger accelerated death benefit base because the accelerated death benefit comes off the death benefit. So we got a larger amount of liquidity available should the client have a health issue. We also have additional funding capacity. Your client that's putting money into this, their income, their assets may change over time. And as Adam said, the traditional approach has zero flexibility with putting more in over time. We don't want to make a contract and have to send 17 cents out. So you might be thinking, well, hey, that's great, but aren't the charges impacted by increasing death benefit? If I'm thinking about accumulation income, is that going to be counter to what I'm looking for? And then, so let's take a look here, Adam. Let's just give the group a little bit of an overview. So I started with just a plain old male 45, 25,000 a year. Let's pay this for 20 years, and then let's solve for income. So traditional approach is minimum death benefit, maximum accumulated income. You know that, we've done it for years. But what if we increase the death benefits? You see here, we're paying traditional approach, balanced approach, 25,000 premium on both sides. But look at what we've done in the second row. We've taken the face amount from 361 to 544,000. It's a 50% increase on the protection. It's a 50% increase in that bucket of money that's available for the chronic and the critical accelerated death benefit. But now you're probably thinking, what does this do to my income? Take a look at that next row, the income row. We have $87,000 of tax-free income per year on the traditional approach. It's amazing. It's striking to see how little the income drops with that additional amount of protection. 50% more protection, 5% less income. It's striking. And then if you look at the amount of funding capacity, that's also increased by 50%. So if your client over time wants to put more money in, they've got that capacity. So the thought here is, there really is not a significant drawback to doing this. There's a much bigger benefit to the client, and it's just something that a lot of people don't think about. And then obviously, we always do what's right for our clients first, but the target premium, which is what we tend to like on the call, that's also impacted a positive way too. So my thought here, bottom line, is not every carrier can do this. If you like this approach, get in touch with your crew over at Life Brokerage. The next time you have an accumulation case, let us show you how we can make this balanced approach bring more value to your client and probably make that other advisor that might be competing with your client, if you ever have that, kind of irrelevant. So, hey, Adam, thanks so much.
Yeah, thanks. It's not coincidence that Steve's here. We went out and sourced products in the market. We tested this because there's drawbacks to it, right? There's some companies that it will be a 50% reduction or close to it when you make that change, when you put 50% more in. Logically, it probably should, right? Depends on where the charges are. So a lot of the charges are just not in the accumulation phase, and beyond. It's a low charge structured product that North American has. They're not the only company, but they were the company that worked best with this concept. And because they have built-in chronic and critical illness built into the policy with living benefits, it gives the client a whole other bunch of options. And that's what we're trying to create. We'll kind of come back to this funding capacity situation. It's going to have some other relevancy and some of the other stuff we're talking about too. So the second part of this, again, there was kind of three parts to this conversation. The first part was a different way to look at permanent life insurance and the structure of it to create more possibilities, right? The third part, which we'll get into in a bit, is Rick talking about how whole life contracts for college funding and for generation 3 funding is really valuable. The middle part of this conversation is around the Secure Act changing and some of the implications of that and some of the real world situations that we're seeing with people dealing with the fact that you can't do a Stretch IRA anymore. So the Secure Act came out. There was two parts. The part one was introducing new provisions. Part two kind of solidified everything recent couple of years. So with Secure Act, the impact is the main impact for us as planners was the elimination of Stretch IRA provision. So this was something that was just kind of customary that, again, when we're talking about where we're not in 2000 and 2011 and 2020, was something that was in the toolbox, right? Stretch IRAs. And people took advantage of that. And you could really leverage it out and create this generational wealth by inheriting money and not having to pay taxes on it pretty reasonably close in time. So what happened is that it requires a 10-year liquidation rule, which limits some of the annuities you could purchase in qualified plans. It limits a lot of things, right? They also in the Secure Act, and not everything's pluses and everything is pluses and minuses. Not everything's bad. They delayed age requirements for RMDs, which helps with planning. There was more exceptions for early withdrawal of assets. People in circumstances that were, unfortunate circumstances. There's a number of exceptions that were added where people can access their money. It also removed the requirement to do RMDs for Roth IRAs, which is good because you can continue that tax-free growth without having them kick the money out. So it wasn't all bad, and some of these things can be used kind of in conjunction with each other. But kind of wanted to cover that because it shows us a scenario which we're going to go on, which is that there are other types of taxes that happen at death. One is the IRD tax, income in respect of a decedent. So if you inherit qualified money, if you inherit IRA money, that money has to be paid out in taxes, whether you pass away or not, which is fair from a government standpoint, right? Because if you were alive and you had to get it, you would have to pay taxes. So why wouldn't you have to pay taxes if you inherit it, right? So we're looking at an example here, a female age 73 and a male age 45 is her son, and he's the beneficiary, right? So if she does RMDs and spends it down at 5% at life expectancy for her, which is 89, it's reasonably going to be worth around the same, give or take. It's going to be worth a little bit more, right? She's kind of just spending it down and, dying with what it was when she started taking RMDs in this example. So in that example, there's going to be $183,000 inheritance due at either the time of death, if he chooses to take a lump sum, which a lot of people actually do. They take that hit, which puts them in a higher tax bracket and has a lot of other issues, or he can stretch it over 10 years. So when we look at the planning that we're going to do, we're on either or both sides of this planning when we're talking about meeting with clients. So your client may be the IRA owner herself. Your client might be the IRA beneficiary, or you might have both. Now, I'll tell you, it's probably unlikely you have both, because if you look at it, this article that I found and I'll share, and it's at the top. It's from this wealth management blog, but it says about 80% of children leave their parents' advisors when they inherit money. So, $4 out of $5 is going to walk out of your practice when your clients are dying. So if you could start to do that generational planning and having these conversations, it's actually going to help you possibly keep the assets as well. But when you talk about planning for the IRA owner themselves, the thing that you could do, obviously, is you could ensure that transition cost. You have to make some liberties as to when that might occur, but your dollars can serve double duty, because what happens is if you can project that at life expectancy, there could be $180,000 tax, $183,592 in this example. You could go out and buy a life insurance contract, 73 years old. This example, it's $600 a month. You could get an IUL that's guaranteed to age 100 with North American. It also has chronic and critical illness built into it. So you can start to do that planning for generation 2 and setting that up, getting introduction to generation 2 if you don't already have it, and do the planning so that they could actually inherit this money and put it to use right away. So, and again, inheritance is great no matter how you get it. Would I rather have $4,000 a month, or would I, for 10 years, or would I rather have $500,000 to go do something with right now if I'm, inheriting this and likely in my 60s in this example. I don't know the answer to that, but if there's planning ahead of that, then you can put that whole $500,000 to use, and you're not going to give away more than you need to for this higher tax bracket, and you're not going to have to stretch it out and operate by the government's rules. You could just have a pile of money that you've already earmarked to do that. The other planning that we could do is for the IRA beneficiary themselves. So if I know that my parents are heavily in qualified assets in this example, if I'm the beneficiary, then I could start to think about how I'm going to pay for that tax and inherit that money and deal with these IRD taxes. And this is where that balanced approach comes back into play, because it's starting to take some of the things that I might do anyway for my estate planning for my kids. I could start to do that in my plan that also can absorb that inheritance, which is kind of an interesting kind of twist that Steve wanted to bring, and we're gonna show that in a moment. But again, two people on the call. There's two companies on the call. There's Universal Life represented by North American, and there's obviously a lot of carriers that do that. And there's Whole Life represented. So if that generation 2 is trying to fund this future liability, higher upside, more flexibility. We'll show you in a second something creative Steve came up with his product with that balanced approach. And then, of course, Whole Life, it's guaranteeing it. So taking away some of the upside and flexibility for that predictable guarantees. I'm not partial to either. The right decision is the one the client makes and the one that's right for them. But if you have the best in breed of these types of things, then the client can have their choices. And that's kind of what we're bringing to you as a solution today. But Steve, if we want to cover what this is here, this example you showed, by doing the flexible approach and creating this extra ability to fund, what did you do here? And tell us what your thoughts were with this example.
Okay. Hey, all right. Hey, thanks, Adam. Hey, and I just want to give the group one quick nugget on that scenario we looked at a second ago. And if you take a step back, we've got a female 73, mom owns this IRA. She is going to let that money be inherited by her son. The son's 45. So mom's either going to want to do one of two things. As we saw a minute ago, mom might feel like, hey, I want to pay the taxes. I'll prepay the taxes for my son. We saw that $600 a month is going to guarantee the 183 available for the son later. He's good. Now, the internal rate of return on that death benefit is about 6.3%. That's north of 9% in a 35% bracket. So we can show you time value of money that makes it very clear that life insurance is a superior structure, a superior vehicle. So in this case, what if mom says, hey, look, they get what they get. After taxes, they'll be fine. They'll have plenty of money. In this case, what we want to do is we want to say the son, male 45. Let's do some planning now to provide for money and resources at a future point in time so that 183 is pre-funded also. So what we did here was we looked at that balanced approach. We said $25,000 a year premium, but we're bumping up the death benefit a little further so we have capacity to receive the IRA dollars. So you see here in year 18, we're assuming mom dies in year 18, $524,000 is the value of the IRA that the son is receiving as an inheritance. What we're going to do there is we're going to deposit this into the life insurance policy. We're bumping up the death benefit at the start. There's no underwriting needed, and we're not triggering any adverse tax consequences or modified endowment. So then in year 19, what we're doing is we're going to take a loan from the policy for the amount to pay the tax, the 183. So this is doing a couple things for us. Number one, it's creating that liquidity so that the son will not have a challenge where we're going to get the money from to pay the tax. The second thing is we're recharacterizing the tax treatment of this inherited asset going forward for the son. The money will then grow on a tax-deferred basis. The son can take future distributions out of that because there's a bigger amount of money there than the amount we're taking out for the 183 for tax. The money can come out tax-free later. The death benefit will be paid tax-free. And also that death benefit, as we keep talking about, will be available for distributions while it's tax-free. So we've got a multi-purpose plan. We have recharacterized tax treatment. We have diversification on the asset, a non-correlated asset, and we set up a funding source for the son where he's got the money to pay the taxes.
Perfect. Yeah. So, and again, not not unique to North American, but fairly unique in that most companies aren't going to be able to accept that big lump sum in year 18. They're not going to not require underwriting to accept it and increase the death benefit in the way that this is structured. And because their contract is efficient in the way the cost structure is, it accepts it, it allows it to be distributed back out. And that balance approach creates the possibility to do all of this. And that's why, we talked about a real life example of someone going, that what they did was they rounded up by 17 cents. I do it every time I get my electric bill. I'm not going to pay, $187.38. I'm paying $200. And then next month it comes off and maybe I pay 150, like that's what I do. And a lot of people do that. We had a client, real life example, paid 17 cents more than their premium and they met the policy. We actually were able to reverse it back out. They had to sign a form and they had to get a check from the insurance company for 17 cents and go cash it. And then they had their non-mec back again. So when you don't do it at that razor thin of a margin, you create other possibilities at the expense of less cash value or less income. But North America is very efficient in that. And that's why they're here today, because it's only 5% difference for 50% more funding. This is the same example as the client earlier. This is the client that wants to do some planning for themselves and create this tax-free bucket. They also happen to be our example of the client that's inheriting this IRA later in life. This policy serves multiple purposes to do that. So, and Steve and I talked a lot, Rick. So, and Rick can talk. You can put one slide up there and he probably could talk for an hour or two. He used to be head of advanced markets at another carrier that we work with. And it's just, he knows a lot. And I'm excited that you're here with us. So he's been patient to talk about what he wanted to talk about today, which is a different take on the generational planning, which is that you're talking more about planning actually for generation 3 with this, right, Rick?
Yeah, I mean, thanks for allowing me to be here on the call today. I don't know if it's good or bad for everybody, but the camera's broken on my computer, so they don't get to see me. So it's probably good in the grand scheme of things, but here I am all dressed up and no one can see me. So that's where we're at. But I want to talk today a little bit. You asked me to talk about generational planning. When I think of that, I think not only of just, in terms of leaving wealth from one generation to the other, but how do you create wealth at all different levels, right? And life insurance is a wonderful tool to do those types of things. And interestingly enough, we talked about a case study that we'll go through a little bit on a business owner looking to buy insurance on a 3-year-old son. And it's a topic that's kind of near and dear to me as a 49-year-old with a senior in high school right now. The costs of college are a real sticker shock and the real deal. So this is kind of something that's really kind of true, real to heart. And we've done some cases. I mean, New York Life, we tend to be in the brokerage side in the pretty high net worth marketplace. We did a couple cases last year where we're talking about $15 million of insurance on juvenile and children based on the net worth of the parents. So there's some amazing things we can do as far as that goes. But it goes to your question of what is generational wealth? Is it 15 million, 10 million, 5 million, whatever it is? But a lot of people kind of on the more pedestrian level are looking, saying, look, I got this glooming tax or financial issue with college I want to take care of. But not only that, I think people want to just take care of their children and make sure they're set up for a good life at the end of the day, right? That's what we all want of our children. So life insurance is a good tool to do that. And what's interesting is when you look at things, one of the biggest issues is, of course, college funding when you have little children. This example here, a 3-year-old. We ran some numbers that you can look at when you compare kind of life insurance to the other options that are out there, whether it's 529 plans, prepaid college plans, all these different things out there. And I like the term you use, Adam, with the balanced approach, because there is no one size fits all with this type of thing, right? I don't think anybody would recommend putting all your money into life insurance or all your money in a 529 or all your money in a prepaid tuition plan. I know, speaking for myself, I did all 3 of them, and I think there's a lot of people that would do that type of thing. And when you look at what's there, we also talked about the Secure Act. I mean, the Secure Act made 529 plans a little bit more attractive than they were in the past, because there's provisions in to allow you to roll kind of unused funds up to $35,000 with unused funds over a period of time into a Roth IRA for folks. But what that doesn't do is it doesn't provide life insurance protection if they need it down the road. And what we're really trying to do is build kind of a legacy plan for an individual so that even at a young age, they have money built up for college. They can use the money for anything they want to use it for, whether it's wedding costs, we hear is a big one, right? Down payments on first homes, and then certainly retirement income for individuals. So we normally build these plans to encompass all that built into one piece.
And what makes New York Life unique, or, special for this, Rick, and I think you're going to get into it in a second, is the ability to do it in one shot. So if you're doing estate planning for that 73-year-old, we had that example, right? And you've already taken care of the 45-year-old beneficiary. How can they do and take advantage of discounted dollars from New York Life specifically to do this? And then talk about that for this example, for this 3-year-old that we're showing here with the PDA account.
Yeah, right now New York Life has a premium deposit account special going on right now, and basically we're giving you 12% first year on your dollars, and then it's 5% thereafter on a 10 pay or shorter on a whole life contract. So that's got some real discount and real appeal to people. They can be modest net worths or super high net worth individuals. It doesn't matter. People like to see the discount on the dollars. So in this case here, you're looking at we're using an example here where you're doing a 10 pay of $2,000 a month, $24,000 a year in premium. So it's $240,000 total spend. And with the discount on the premium deposit account, it'll be $183,926 one time, one shot to pre-fund that policy. So when you're talking about older age clients, they tend to like this to take care of their grandkids because, let's face it, if you're in your 80s and you're doing this, you don't know whether you're going to be around for the entire 10-year premium payment period. And people want to make sure they have some level of certainty when things are funded. So this is actually a place where we see the premium deposit account used quite a bit, even without this special, but with the 12% special, it becomes that much more attractive. So, and what I think the art of the planning in this type of thing is, particularly with respect to college situations and distributions early in a contract, is how much do you take out? And I know we talked about this prior to this call, Adam, whether you want to take out more than your basis or less than your basis, you want to use loans, you want to use withdrawals, all those options are available within the contract. It's just what's better for your client. So this example here, we're using a 10 pay, $2,000 a month, $24,000 a year. It's a 10 pay paid up, no premiums. We're to fund this thing immediately up front for $183,000. And what we're showing is at age 25, you can take out $120,000, which is half your contributions from a basis perspective. Still well under your basis. Take out $120,000. Your cash value at age 64 is over $2 million, and you're able to get income for life of over $100,000 tax-free and still leave a legacy of about $3 million. So it's kind of a cool strategy for people to see how this all comes into play and how it can complement the other planning you have. So I think the idea here of taking distributions at 25 was to say, look, if you take loans or you have money that you're getting from somewhere else during college, at the end of your college experience, you can take that money out and repay part of them or all of them, depending on what the situation is there. Make sense?
Yeah, and so for this one, you don't have to do this. You may not be repaying student loans. We're showing to repay student loans as opposed to taking distributions every year during college, because there's a deferral there, and maybe it's not, maybe 25 is the right answer, maybe it's 20, whatever the case may be. But you don't have to do any of this. It's all available to you. I know you looked at scenarios here that you share with us, taking 75% out, taking 180 of the basis contribution, right? And how that impacts it. Less income, less cash value, less death benefit later, but they get more money towards college if they need it, or whatever it might be at 25. And then even taking all the basis out completely tax-free, $240,000, and still having this, this legacy. So when we talk about what is generational wealth and generational wealth planning, this is like a great story around it, right? We talked about, again, the definitions that we look at keep getting pushed out by the government to say, oh, it's, $27 million states or generational wealth that are taxable. Well, for $183,000, you're creating a $56,000 arbitrage right off the bat, because you're getting a $56,000 discount to fund something that could be worth millions and millions of dollars for your family down the road. And again, if you've already done your estate planning, if you've already done your retirement planning, if you've already done the generation 2 planning to take care of them to inherit things, this is something that we see a real calling for in the market. And I just want to put this chart up here, and we're life brokerage, right? We represent a lot of companies. We're not partial to any one. We don't play any favorites, but we do display things like this to show things. And what I found was interesting with New York Life, and it's true of other companies too, and we like our other whole life options, but especially with New York Life, look at the consistency of the dividend, Rick, and that talks to the predictability and guarantee. Your dividend has not fluctuated much in the past 15 years, right? I mean, relative to the rest of the companies out there.
I think New York Life, obviously I'm biased, but I think New York Life's done as good a job as any, if not the best job in the marketplace of managing through the low interest rate environment. And that's what you're seeing there. And it's a function of how the company is structured and how we have some other businesses at our company that are helping to support that dividend within the company. And the proof is in the pudding, as they say, right? So you look at it and you see what we've been able to do over that period of time. We all know interest rates went way down, right? We were able to hold that dividend. And I think that's important. And I also think that the latest trend, you've seen a 20 basis point uptick in dividends between the last 2 years. So we're up 40 points over the last 2 years, which is, a testament to the new acquisitions we're buying. And hopefully that'll continue as a trend. So we'll see some higher performance in the whole life contracts as time goes on. I mean, this is an interesting marketplace because for the 25 years or so I've been in the business, we've been a declining to flat interest rate environment, right? And now we're moving into an increasing interest rate environment. And we're going to see how all these products kind of work in that environment. But I appreciate the kind words, Adam, on this, but I do think New York Life's done a great job of managing the dividend during this interest rate environment. It's a testament to the financials that we have. And people are buying whole life because of the predictability of the product. That's part of the reason. I mean, people buying it are conservative clients that want predictable returns. And that's really where we fit. We're not going to be the highest performing product that you can illustrate, but ultimately, over time, I think you're going to get what you pay for with the whole life contract. And I think that's what people want, particularly with the limited pay options where you can pay and then stop paying at particular times.
Makes sense. Yeah. And just what we generally recommend on any of juvenile insurance is to put these purchase guarantee increase options on them. I don't know if you want to talk just briefly about what New York Life does for this 3-year-old. If this policy is purchased for him and he has all these benefits for it, that's not the end of his life insurance story, right? If his health changes along the way, he has options to get guaranteed coverage through that rider with New York Life, correct?
Yeah, if you buy the policy purchase option and you're under 21 years old, there's 9 times that you can increase coverage by up to $150,000 based on what's there. And one of the things early on in this business that someone told me, and it's always stuck out in my mind, is it says everyone becomes uninsurable at some point. We just don't know when. Okay. And so obviously, if the opportunity to insure someone at a young age who's presumably healthy, we never know what's going to happen. I heard a presentation last week with someone who looks totally healthy, but the person indicated they had a Crohn's, and this person said they can't get insurance right now because of it. That may not be the case. I'm sure someone at Life Brokerage could figure out a carrier to get them with that condition, but ultimately the point is they're not going to get great rates with that, and who would have known? So having this coverage and the ability to increase coverage at a young age can be important for some people.
Yeah. And I know you also wanted to talk about, this is the current rates of the PDA. It changes when you purchase your PDA, it's guaranteed when you purchase it, but then, next month's PDA is going to be different, right? So I know you wanted me to just throw some of the information on what it currently is in there. We'll just share this for when people get the slides, but you could see the effective return on just the PDA, which is the premium deposit account. I don't know if you want to talk just for a second about what that is. If you aren't familiar with it, it's a way to discount your premiums by making a lump sum payment to New York Life, correct?
Right. It goes back to what we said, that $240,000 and $12,000 annual premium a year, or $24,000 annual premium going in costing 183, I think it was in the numbers earlier. There's an effective yield because you're getting 12% in year one and you're getting 5% thereafter. So what this chart is showing, and we can give you this offline, what it's showing is if you did a 10 pay, your effective yield on that is 6.49%. Okay, so your effective yield on your money over that period of time is 6.49%. So that's what you're getting on a guaranteed basis from New York Life, and then on top of that, you have your policy performance in there. So that's the effective yield on the products, which ends up being really, really attractive. But we can send that out separately, Adam.
My opinion of PDA rates, this is just my opinion, but I think it has some validity, is that it's very hard to introduce a new policy into the market, right? It takes years and millions of dollars for companies to change even slight things to respond to the market, right? And what happens is that life insurance uses portfolio rate pricing, so they're not like annuity companies where they shift from week to week of what the pricing looks like. These are, for the most part, a company like New York Life, and not unique to them, but a company like New York Life, it takes a while to adjust pricing. So what the PDA account does for carriers, it allows them to basically use new money, these higher interest rates, and with a client, it has the ability to pre-fund, and you could pre-fund not just the whole thing. You don't have to fund all 10 years like we showed in this example. You could fund a few years, right? It has to be at least 4 to get these rates. It's a way to stay competitive with things and to keep it all in-house, and for a company to allow you to acquire their product at a discounted rate, subsidized essentially through them, through their guaranteed bank account offerings, that allows you to do it without having them to necessarily reprice, because next week, next month, next year, interest rates can change, and life insurance is not that nimble from a new pricing standpoint to just come out and to be market competitive. So these PDA rates allow for companies to do that, and this is among the highest I've ever seen. There's 12% year one and 5% thereafter for up to 10 years. You can see that just even if the return on the underlying policy is flat, which it's not, the whole life has its own growth, you're getting over a 6% return on just the money in general, just going in. So it's really compelling. And just kind of want to close and then take some comments from people. But I wanted to thank New York Life and North American again. I appreciate Steve and Rick whenever I talk to them, because they don't offer what the other one does, right? So to speak. I mean, Rick doesn't have Index Universal Life, and New York Life and North American doesn't have Whole Life. And oftentimes carriers or advisors can be biased if they represent Whole Life, that's the only answer, right? They represent IUL, that's the only answer. And I think that there's compelling stories for either of them, right? And I just wanted to make sure that we kind of highlighted what they were and thank them again. So with New York Life, industry leading PDA rates. They have a survivorship whole life product for estate planning and just cash value that's fantastic. We actually sell probably more of their survivorship, at least in premium, than their single life. As good as their single life is, their survivorship is that much better. And they are in the ABLTC space, much like some of the other companies we have there. They have this guaranteed asset-based long-term care product. So I wanted to make everybody aware of what New York Life does beyond what they talked about on this call. And then with North American, same deal, right? So we talked a lot about their Index Universal Life. We didn't talk about, because we don't know exactly what it looks like, this product that they come out with in a month that we're very excited about. So we know, just enough to know that we're excited about it, because it's going to be very dynamically different and disruptive in a good way. But they have living benefits on the majority of their products, even on term insurance. And it's priced with accelerated underwriting. It's as good as any other term in the market. I'm very partial to that, because to have that term insurance with living benefits is huge, and it's convertible as well. They have lifetime guarantees on their products. So if you're not looking for accumulation and you're looking for a protection-based product that also has some cash value to it, to have a lifetime guarantee is huge. I can't stress how much that is after looking at policies over the years and reviewing policies that didn't have that, how it could be problematic. And then, again, their structure in their accumulation products is designed to have low cost first and then dynamic crediting as well. So I think costs are more stickier than the returns in Index Universal Life personally. So the fact that we have this low cost product, which was illustrated by the fact of how little of an impact increases to the face amount are in it, I think that's just important. And, again, we encourage you guys to get familiar with both of these companies, and we love working with Steve and Rick, and wanted to thank them for their time and talk about the other things that we're doing with them. So I'll leave everybody with that, and I'll see in the chat if there's any questions from anybody. Let's see here. I actually do not see any. So with that, unless anybody give everybody kind of a moment or two, but if anybody has any questions, let's see. We have some comments more so than questions. So we have a comment from someone, will they get a copy of this PowerPoint? That's yes. And then another question for Rick about the structure of these policies. When you see a grandparent buying a policy, they're saying, who's the owner? So Rick, what are you seeing there? I know what I see, but I'd rather hear from you. You see a lot more volume than I do. When people are doing single pay PDAs, who's the owner of that contract, and how easy is it to get into the hands of the children, or at least the generation 2, which is what we see. We generally see if it's a grandparent buying it, it's their children or the owner for the purposes of their children. what do you see around that, and how does the money end up getting to the Generation 3? I think it's actually anonymous attendee with the best question of the attendees. Thank you, anonymous attendee.
Well, here's the thing. I think that what's interesting is you could certainly have the second generation own it. So you have the parents own it, like you said. I think in the more kind of complex scenarios that we've seen, what we've used is a situation where the grandparent would actually own the policy. In this case, you're talking about a grandparent owning. Grandparent owns a policy with the contingent owner being a trust for the benefit of the child. And the reason you do that is because if someone puts a large amount of money in these policies, particularly like a lump sum, in a lot of the context, what they want is they're concerned that they may need that money back, which is every client's concern when they make a large deposit into any type of life insurance investment. They may need the money back. And so since we're not talking about a estate tax situation normally in these scenarios, what the grandparent wants to do is make sure they own the policy, because their biggest concern is a long-term care event. That's their real concern. Like, if I need it for a health issue or whatever, I can take the money back. So what they'll do is they'll have them own it. And then what ends up happening is that if they need the money, they'll take it. If they don't need the money, then what will end up happening is that policy will, upon the demise of the grandparent, be transferred to the contingent owner, which is a trust for the benefit of the child. So we've done a fair amount of that planning, and that's kind of unique, but that's what we've seen kind of in the higher end space, where people are putting large deposits in because they want to have access to that money.
And you could joint collaterally assign the PDA and the account value, right? So if someone gave you $182,000 in that example, theoretically, they could collaterally assign that for, an equity line loan after, I think, a year.
Cash value line of credit or something. Yeah.
Within a year. So, and they probably will have the majority of their money anyway. So they don't really necessarily have to lose access. And I think that was a great question by them, because this business of a contingent owner for a trust, it allows for a lot of flexibility, and that's interesting that you're seeing that. We see also a lot of times where the parent of the child is the owner, and then it's transitioned later as well. There's another question also for you, Rick, and it's that why is survivorship whole life good for cash value, or recommended? Why is that something that we're seeing? And I think I know what your answer will be, but I'd rather you answer it. I think it.
Well, the internal charges are less on a survivorship product. I mean, that's the primary driver. But also, when you look at ultimately, internal pricing alone, you have to look at the actual pricing structure. In the survivorship product that we have, people love, because by year 6 in that product, you have more cash value than they have in premiums paid. So as a real quick ramp up in terms of when your premiums, when you start to earn money, if you will, in that product, is really ramped up pretty fast for relative to a whole life contract. And so people gravitate towards that, but you get more death benefit, and the expenses are lower within the product, which leads you to higher distributions effectively. So if you look at that, you get better distributions in the survivorship product.
And if you combine that with the PDA, I would think the break even's a lot sooner than 6 years, right?
It is. It's probably closer to 5 on that, but it's really the underlying pricing structure of the product. It's priced a little bit better than I think the single life product is in terms of overall structure there.
Well, great. Well, and unless anybody has any other questions, I appreciate people contributing there. We had a gentleman, Larry, that talked about the country's debt and a lot of our unfunded liabilities. And, certainly that speaks to the possibility that maybe taxes are not at a low point. I know there's a lot of talk now that we might have reduction in taxes. That's a current administration. That's a 4 to 10 year look on things, right? But Larry's point he put in the comments, I wanted to mention that that's an interesting thing. Again, when you talk about some of the stuff that we're doing, reducing the risk of taxes later, and we don't know where taxes are going to be, certainly they're, I'd always want to pay less taxes than I need to, but there's no guarantee that that's going to be the case. And Larry's points are well made that it's, there's some substantial debt and obligations that our government has, and revenue is the way to pay for that, right? Depending on what type of tax that is, it could be income tax, and having money that's in life insurance is protected on those parts of the code that we talk about, very valuable. So again, thank you everybody for joining us. Thank you, Steve and Rick, for the conversation. And I hope everybody got something from this. We'll send all the slides out to everybody, and hope everybody has a great day. Thank you.